Hello, everyone. It's great to see you all here in New York together at the headquarters of Bloomberg. Since we're halfway through 2023, I figured it'd be a good time to talk about our outlooks for the rest of the year. So, without any further ado, let's kind of dig into the big picture. What's your view on the next 6 months? Maybe what's happening in top line growth? Give us a little bit of overview for each of your sectors.
I'll start. The pace of growth is going to slow, but most of the sectors, other than some sectors exposed to the consumer economy, should still continue to see growth. There's winners, big winners, and some that are going to have a tougher time. Aerospace is going to be the strongest. Non-res is going to kind of be a mixed bag, but generally, it's still going to be a decent year. It's just going to show a slowing, which should probably continue going into 2024 from a demand perspective.
Yeah, I'd echo Karen's comments. Very similar. Growth is going to moderate both on the top line and the bottom line, partially due to a comp issue. We're starting to lap some very tough comps on the pricing side and volume as well. So I would certainly expect top line to moderate along with earnings, and that probably will continue into 2024 as well.
Likewise, here in electrical equipment and flow control, some of the best companies are the ones that are most exposed to high growth areas like the grid, utilities. They have record or near record backlogs still, double-digit organic sales growth still possible for the second quarter, but then third and fourth quarter they run into tough comps, so slowing down at high levels.
Yeah, and I'd also chime in. I don't think there's a lot of risk, at least on the machinery side, just because we have these near record backlogs. Order books are essentially filled for the year. It's really going to be more of a function of what the supply chain is going to permit in terms of production rates to really have changed any kind of delta, at least in the back half, from my perspective.
And we did have a few surprises in the last quarter on that, where a few companies actually got more out the door than we expected, like Parker Hannifin. So that could happen, and people will worry about the backlog slowing, but they're going to have more production because now they can build.
Yeah, and anecdotally, I mean, we're seeing production rates still even continue into 2Q. So I think that the setup, at least going into this coming quarter, from a demand production perspective, should still be quite strong. Yeah.
We are watching more orders, I guess, and execution.
Great. So any major weaknesses besides just kind of easier comps and things might be moderating, because 2022 was a pretty big year for a lot of the industrials.
Yeah, I mean, on the automotive side, there are still some weaknesses, primarily affecting companies like TE Connectivity, Sensata, parts of Eaton, ITT. Production at auto companies still running 10% below pre-COVID peak. That's one area that we're watching. Then parts of the data center space, there is some excess inventory in the channel. And then residential construction, this is the big one. Although it is not a huge exposure for large electrical equipment makers like Eaton or Hubbell. And there is some exposure on the flow side, which is mainly in Pentair. That's probably the weak spot for the flow coverage that we have.
I do have exposure to residential construction with the HVAC companies, and that's definitely down high single digits. It depends on their mix. For Trane, that doesn't really mean that much. For some of the others, it's a little bit more important. And then a couple of the more broad-based companies that have exposure to consumer, like ITW and 3M, they're seeing weakness. 3M, it's more just consumer spending. ITW, it's additionally construction. They do have construction exposure. So the DIY and some other areas are slowing for them. So, yeah. But other than that, the industrial side is still holding up.
Yeah, and most of my end markets still quite strong. Trucks, construction, ag. But to Karen's point earlier, the risk and what we'll be watching as we move into the back half is what's happening with backlogs and order rates. We think we've probably peaked on backlogs. Order rates are starting to decline, pretty broad-based. We'll be watching inventories very closely. You're starting to see both new and used inventories continue to rise, which will really set the stage for production rates as we move into next year. But really, I mean, by and large, despite kind of the softening macro indicators, a lot of that hasn't really yet trickled through to our companies. Yeah.
On the backlog side, there were some positive surprises in Q1 in my coverage. The likes of Eaton and Hubble, they saw their backlog tick up from Q4 to Q1, and that came on top of record revenue. So they had a sort of a difficult or high bar to clear, which they did. This is driven by a lot of structural trends, electrification, switch to electric vehicles, but we are seeing some slowdown. On the flow side especially, we saw declines in the orders of Xylem. Flowserve orders also down. But when I take a step back and look at the absolute level of orders, still above $1 billion for Flowserve, which is a good number, still above $1.5 billion for Xylem, which is also a good number for them. So things have come off from peak in terms of order intake for some, but they are leveling out at a good level.
Let's talk more about profitability. Price and inflation have been kind of hot topics since last year. Are companies still getting price? Is that still something they can benefit from?
Mine are seeing price, but of course it's slowing down. I mean, we had the HVAC companies had 4 price increases last year, and their pricing grew double digit. That is not going to happen. I think they're still, in general, they're getting price through, and price cost is, each quarter it gets a little bit more positive for them, but it's not going to be the story it was, the first half of last year. There'll be a little more slowdown on that front.
Yeah, pricing very strong still. Yes, moderating. Yes, we'll continue to moderate in the back half, purely on a comp perspective, along with profitability. But yeah, it's still, and I think as we look at the first half, particularly 1Q and even into 2Q, this is when I'd expect margins to peak for most of my names if they haven't already. We had a little bit of that mismatch of pricing being still remarkably strong and input costs starting to moderate a bit. So I think we're probably, at peak margins for most of my names, and those will just, sequentially moderate to the back half of the year. And then, as we move into next year, consensus expectations are essentially for flat top line and earnings growth, very modest. So it's really going to come down, I think, more to a cost issue next year and managing costs and execution.
In my coverage in general, I would echo the comments from Karen and Chris. We usually hear they do one last price increase, the regular price increase in January, but they haven't done sort of exceptional or abnormal price increases to compensate or offset inflation because it has abated. So yes, the mechanical slowdown will happen for electricals and flow control as well, although it really depends on whether the margins will peak or whether they have peaked. Within vehicles, for example, we're still, because we're below peak volume and the labor force that has been retired or it's been lost, and the supply chain issues they faced, that's not fully gone away yet. So the output recovery hasn't fully occurred in automotive end markets yet. So the margins for the likes of Eaton's vehicle division or ITT's motion technologies segment, for example, which supplies brake pads, they are still below peak margins. Whereas electrical segments, aerospace, things have recovered back to prior levels.
And I'd say, most of my pricing this year is carryover. There's been very few that have announced incremental pricing actions this year. There has been a few, but a lot of it is carryover pricing.
How about regionally? I know a lot of these are global companies. China's kind of been slow to recover more than people expected. Is that going to impact any of your outlooks for Europe?
Yeah, I have some companies with some pretty big exposure. 3M and Emerson in particular have exposed to China. So they are the biggest. Everybody's there, but it's impacting them most. And it's just coming back slower than expected. Europe, it's mixed. I mean, it is slower, but we've got the HVAC companies that, can't build enough heat pumps, so there's some moving parts. As there is on this side, because of all the federal spending and we don't know the timing of it, right? So it's kind of, one of the titles I used was, it matters where you play, right? And some sectors are going to stay robust, and that's true in Europe too. But it is generally slow.
Yeah, and I think China could be one of the upsides as we look into next year, coming off a pretty low base. Again, for machinery companies, it's typically less than 5% of sales. CAD kind of bounces between 5 to 10%, but it will be below that 5% this year. So not a significant piece, but it is the largest equipment market in the world. And that's, I think, maybe could be one of the positive surprises as we move into next year, particularly if, the US continues to decelerate here.
Yeah, for me, EMEA is pretty big for the likes of TE Connectivity, for example, 35% of revenue, and then a little bit less for Sensata. Although, though it seems like there's an auto angle there, and there may be a bit of weakness in Europe, which is reflected in their guidance, which is softening in the near term. But again, to Karen's point, it matters where you play. The likes of Rockwell, for example, they have exposure to EV manufacturing or battery manufacturing. Demand is looking good. That also goes for China. It doesn't matter that much whether you see a GDP recovery or not when you're more exposed to those end markets. So not a huge concern, but we're watching it.
Great. And, companies have a lot of capital to spend. The buybacks are always popular. Is there any big deals happening? Any kind of forecast into what companies will most likely spend their free cash flow on this coming year?
Yeah, for me, Evoqua and Xylem was recently closed. I guess that's a big one. Eaton has a lot of capacity to spend, and they haven't done a major deal in a while, so they could do a deal.
But I'm of the opinion that major buybacks will probably not happen. Things will slow because we don't have the weak share prices of last year. The peer groups have recovered pretty much back to where they were early 2022. So maybe less scale purchases.
In dollars, right?
In
But
dollars,
if
right.
M&A slows, the percentage of the capital allocated to that could still remain.
That's true. And yes, for M&A, I guess the multiples are not, historically at elevated levels. We're not going to see deals at 11, 12 times into. That's going to be difficult, especially for software. Things are, again, historically expensive for the companies to buy. So potentially in percentage terms, we're going to see a huge drop of purchases.
Well, for a while, we've seen a lot of small tech deals, and then we've seen a few strategics. And I think that's still going to continue for most of the large cap multis, except we've had two very large deals, which in Carrier and Viessmann and Emerson and National Instruments, which entailed a two-step process. The big purchases, but also major divestitures of segments. And that was an eventual thing that was going to happen for both of those companies, but they just pulled it forward so they could fund these much bigger deals than they've ever done. And and they're going to see a very significant, both of them, portfolio change. And so those are the biggies. And no, they were looking. We knew that. I didn't expect the divestitures to be timed that way. I thought they do the buy and then over time they do the sell. So that was interesting. But a lot of the other companies have money, but it's correlated to corporate profits, and I think people are nervous. In our numbers, when we've aggregated them up, M&A is down to. And then you've got these one-off large deals, very strategically focused. A lot of companies that have capacity, like Honeywell and JCI, they're buying small things. They're buying technology deals, so they're at high multiples for our companies, right? But they don't really move the needle. And the ones that have the most money, ITW, unlikely to do anything big. Fortive likely to do something big if they could find it. Honeywell has 8 to 9 billion in capacity, and they haven't really done anything big in years. They have a new CEO, and we're going to see if that changes. And then for those are the ones that have the most money. But the strategics were very large, 8 billion, 13 billion for these companies. Those are big deals.
Very
Yeah, and most of my markets are, very consolidated to begin with. So the likelihood of large M&A in the commercial vehicle, ag, or construction space is probably small. Not to say that it isn't possible, but most of the deals are probably more bolt-on in nature, more technology, precision technology oriented. So that tends to be the biggest area of investment, both kind of internally and probably externally as well. And then, repurchases tend to be more of a residual use of cash, but we'll look for, further dividend growth for a lot of these companies. Obviously, Caterpillar, Dividend Aristocrat would expect that to continue, along with a number of the other larger machinery names.
My markets are more fragmented, but the conclusion seems to be the same. Usually the companies do bolt-ons because they can't find bigger targets.
The one I did mention in the discussion was Renault. It's very fragmented too, and there really aren't any big companies to buy left. So they're all just buying up. Both HRI and Ashton do a lot of small deals, and URI tends to do the bigger deals, which there's a shortage of. They'll all do something, and they'll do things in specialty. But part of why they're accelerating the pace, and Ashtead really accelerated the pace, is they need capacity too. And so they're buying these small companies. They can capacitize the branches with more fleet and grow faster. So that's one area where you're going to still see a lot of M&A activity. And in aggregate, it will move, but it'll be a lot of small deals.
Right. So all of you are exposed, all of the companies you cover are exposed to the construction market. So let's dig a little further into the nuances within construction. What are some of the levers that can help or hurt your companies in the next 6 to 12 months?
I could start. Help would be China as we look into next year, just being that it's the largest equipment market. Obviously, residential has been weak. Maybe that starts to stabilize as we move into next year. Some softness in pockets of non-resi, but by and large, given all the fiscal stimulus coming through the system, that certainly provides an offset there. A lot of the leading indicators on the non-residential side have kind of been mixed. Just this week, we got the ABI, which returned to expansion territory, but it's kind of been bouncing around, between positive and negative over the last 5 to 6 months. So certainly all the federal spending will help, which we think, probably limits some of the downside risk, at least as we move into next year, even if we do have more of a weaker, protracted downturn in the U.S.
The timing of how the big money falls out is going to be really important to 2024. You're already seeing some of it in infrastructure, but the IRA will flow much more, and so will infrastructure. So that could be, and it's $2 trillion. Obviously, it's over multiple years. So it's kind of a weird cycle because, you have some soft pockets in commercial, but you've got so much money in the infrastructure pocket, and to a lesser degree, the institutional pocket. So non-res has a lot of different components. Buildings, we're obviously worried about. Retail, obviously worried about, but a lot of those are really low already. So, but the worries come and go with the rental companies. So, they ran on the infrastructure, on the federal money, and then they pulled back when the loan, problems with some of the small and mid-sized banks. Then they had blowout quarters and they're off again. It's really hard to tell, how much the cycle is going to offset the money that's going to be flowing. And so it's pretty interesting because there's worries sometimes and then they forward at other times.
Yeah. I guess there could be some air pockets until the money flows in.
That's a good way to put it.
Yeah, for the rest of the year. But in general, the big risk, I guess, lies within the office space within commercial non-resi. And that is not a huge portion, maybe sort of somewhere between 10 to 15% of a company like Eaton's overall revenue. They tend to lump it together with institutional, which is going to do pretty well with the likes of K-12 education, hospitals, and infrastructure will do really well. So, and if you look at the negotiation pipelines within North America, within the US, they're up. They're actually double what they were 2-3 years ago. So it seems like the demand is there. Maybe when you slice and dice it, it's the commercial and office space that is within that. The office is the weak spot. But other than that, as Karen explained, the other areas are strong. China and Europe, they're less, less important for market coverage. Within Europe, it's more about industrial demand. That's been weakening pretty heavily. But it's also part of it is late cycle, like energy, where we still haven't seen demand decline. So yeah, in terms of construction, it's mainly the office space, I would say, within the US. That's the big worry. We're watching commercial and industrial loans. That's coming down, but still at a high level, about $2.5 trillion. So if the rates peak, I guess, in the near term, we don't have a big recession, things will probably start to level out.
And one thing I didn't say on the from Ashted put out a slide on where the projects are going and how much has been let and how much is on the inquiry level. And there's a tremendous amount of mega projects already getting on the board. I mean, hundreds of millions of dollars. So we don't know how long that'll unfold, but they were the first ones that kind of said, there's this many projects, it's worth 800 for already getting in the hopper for 2024. And they timed it out. And so they're not just talking about it; they're getting to the thinking about stage and designing stage, and then that surprised me, the number of projects that are in discussion.
Yeah.
So
Eaton corroborated that actually, or maybe it's the other way around. 600 billion, I think, is the number that they put out, which I think matches.
Yeah, it was 600 or 800, and then there was another the next year was 400. I mean, and this is stuff that's in serious discussion. So yes, the money's coming.
And according to Eaton, only 25% or so have broken ground. So there's more to come in terms of execution.
Yeah.
So all great things coming down the pipeline, but let's take a more contrarian view. What are the risks that might dampen your outlooks? What can go wrong?
I mean, the macro is obviously probably the biggest. Just the magnitude and duration of a potential recession. That would be, I think, one of the biggest ones. Obviously, tightening credit markets could have pretty significant ramifications, particularly as we move into next year. I think those are probably the largest ones, and there'll be a lot of knock-on effects should we enter a more protracted decline.
It's the end markets we talked about. They could be worse. I mean, obviously it's macro, but could commercial be? I mean, could residential be worse? Could energy fall more? They've already been cutting capital spending for a while, in the U.S. So could that be worse? The upstream side, those would probably be the biggest end markets that I'd say there would be risk other than the macro picture. And the consumer, if the consumer gets worried, it is going to flow to more markets than we think, because even if it's the consumer spending is going to affect it's going to back up into other sectors. So I'd say I'm worried about that.
Yeah, and it's to Karen's point, consumer, and we see trucks probably has the biggest downside risk, just given the short cycle nature of the commercial vehicle market. I think you're probably conservatively looking at a 25 to 30% decline in Class A production next year, which would kind of put us in that 220, 240,000 unit range, which is very similar to other low growth periods. GDP, industrial production between kind of 0 and 2%. That's kind of where that has shaken out historically. But there's probably more downside risk there should we enter a recession. Typically in recessionary periods, Class 8 production will fall 40%, and we're coming off pretty elevated levels, so those numbers could be magnified. And then again, to Karen's point with the end markets, a lot of my end markets are, at or near peak levels, right? So commodity prices, big driver of ag equipment demand. We're starting to see some pullback there. Farm income is going to be down 16% this year. So there's certainly more risk, all broadly tied into macro end markets. But yeah, that's how we kind of see some of the downsides.
What about industrial commodities? If we go into a recession, would the mining still hold, or would it start to pull back?
Yeah, mining equipment's been interesting this cycle in that it hasn't been the boom and bust. It's just been very slowly, gradually recovering. Mining capex is still, I think going to be kind of flattish as we look at 2024. It'll be up again this year. The fleet is still, it seems to age every year. So we have a record old fleet. So there's certainly a need for replacement. So I think there's maybe a little bit less cyclicality in that business as we look kind of going forward relative to some of the prior cycles. But undoubtedly a broader macro slowdown would still have implications.
Yeah, my coverage on the electrical side is definitely a lot less cyclical than machinery. And the big risk there would be if there's a long recession, I guess some of the upgrades that the utilities have planned, the grid upgrades, they could be pushed out. But there's only so much you can do. I mean, when we're seeing all these blackouts and power issues, the grid just needs the upgrades. So there will be some delays if there's a long recession. Some of the planned new solar farms and wind farms, they could get cancelled. That's the risk there. But other than that, not a huge downside risk from that. And then on the flow side, it really depends. I mean, some companies are more exposed to cyclical markets. If energy prices collapse, they could affect companies like Forster or YTT, for example. So it depends on where you are there. But yeah, I guess Chris would have the most cyclical for sure.
Great. Any other thoughts about next year that we didn't touch on?
I think we're in good shape.
All right. Well, that's all the time we have today. So thank you all for your insights and thanks for listening.